G'day guys, Adam Grokey from Johnston Grokey. Today I'm going to talk to you about lender's mortgage insurance, or what some people call LMI. I'm going to talk about the benefits and also how you can avoid it. So the first thing is, a lot of people, there's a stigma out there that people are scared of LMI or paying mortgage insurance. Now, I just want to explain the benefit of it, because really the fact is that if you don't pay mortgage insurance, you've got to come up with a larger deposit. So just a quick 101 on lender's mortgage insurance. Lender's mortgage insurance is an insurance that the bank takes out to insure against you, the borrower, if you default on the loan. So if you borrowed 80% or less, so 80% of the value of the property or less, then you don't have to pay mortgage insurance. Anything above 80% you need to pay mortgage insurance on. And mortgage insurance is actually tiered, so from 80 to 85% LVR, you pay a certain percentage. That then doubles from 85 to 90%, and then doubles again from 90 to 95%. So again, it can get quite expensive. To use some real numbers in there, if you're going to buy for $500,000 and you're going to purchase at a 95% LVR, so that means you've got 10% deposit to cover the 5% equity in the house and your 5% cost to purchase with stamp duty and government fees. You're looking at about $20,000 roughly for mortgage insurance cost. If you can save an extra 5%, so you're at a 90% LVR, you're going to be paying half that at about $10,000. And then if you can get down to an 85% LVR, you'll move down a bracket again and only be paying about $5,000 worth of mortgage insurance. So there's always a tier you can try and aim to get below, but sometimes that may not be in your best interest. For example, if that same $500,000 property were to grow at 2% each year, that's going to be growing by $10,000 in value. So if you've got a 90% LVR and your mortgage insurance is only $10,000, then within a year, if the property market were to increase by 2%, you've actually got back that cost of the mortgage insurance in capital growth. So a lot of people out there say to me, oh look, I really don't want to pay mortgage insurance. I'm like, that's okay. To not pay mortgage insurance, you need to have 25%. You've currently got $20,000, you need to get $100,000. How long is it going to take you to save $100,000? And they say, well, probably about 6 or 7 years. And I go, well, over the next 6 or 7 years, the property market could have moved to $100,000, which means that $100,000 you need to save now is actually going to be $150,000. So you're always going to be chasing the market. So mortgage insurance was designed to allow people with a lower deposit, less than 25%, to buy a property and have that extra risk that the bank doesn't wear covered by a third party. So there is a benefit in paying mortgage insurance. If the property market is flat and not going anywhere, we say don't pay mortgage insurance, save up some more money, because if you're going to buy in 12 or 18 months time and the property market hasn't moved, you're going to be better off. But if the property market is growing, then you do want to get into the market where that mortgage insurance costs, because you'll get the return in the uplift of the capital gains of that property if there's growth. Now, there's a couple of ways to avoid mortgage insurance. The first of all is to have a larger deposit, so save more money, get some gift from family and friends or your parents, and try and get as much as you can to reduce that mortgage insurance cost. You can also get your parents to be a security guarantee, so they'll put up their home or an investment property as a guarantee. The bank can leverage the equity in that property to replace the shortfall in deposit you've got, so you can actually avoid paying mortgage insurance at all. If you've got any questions about that, let me know. Hopefully this has been really good to give you guys some information to help you have some conversations with your clients. Always here to help. Have a fantastic day, and we'll speak soon.